Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope all of you guys had a very good day of trading today. And in today's markets, guys, well, the action was indeed to the upside. Continuation rally now largely erasing the losses that we had on the Monday session. Very decent day for the bulls overall, but the market was indeed carried up mostly by big tech on this session. However, we did have a lot more names that were green than red in the S&P 500. And of course, guys, it would not be a day in the markets this week without more tariff news. Yesterday evening, China coming out and retaliating with 15% tariffs of their own, starting on the US economy as early as next week. So in today's video, we're going to do a few things together. Number one, recap the implications of the new China tariffs against the US economy. Number two, we're going to be looking at a few company earnings that we had today, namely AMD, Alphabet, and Chipotle. Special shout out, of course, to PayPal, Spotify, Pepsi, Ferrari, and Phase as well, which all had their earnings today. But the focus of today's analysis will be on a detailed one of AMD, Alphabet, and Chipotle overall. Thereafter, guys, we're going to take a look at our major market rundown, some technical analysis on the major market indexes, see how they're shaping up now after 2 days worth of bounce. Have we recaptured any major levels? Are we still at risk of downside? We'll take a look at all of that together. Thereafter, take a quick glimpse into our big tech names, as now we are almost wrapped up the entire big tech earnings season. So we'll have a look at big tech and identify some potential key levels where we could be interested in some trades. And that's it for today, guys. No portfolio review. The next one will be on the Friday session. As per usual, I usually only do them on the Monday and Friday sessions overall. So let's jump right into the video, shall we? So the SPY up about 0.67% today, the Q's up 1.23%, and when we take a look at the heat map, guys, we will see that the market overall was fairly balanced. Yes, there was a lot of action in big tech today, but overall, I could not say it's a very bad day in the market. Some names green, some names red, but overall, more green than red in the markets today, although it was a little bit top heavy. Financials and healthcare coming down on the day, but the bottom half of the market not performing too poorly. Take a look at the one-day relative, you'll see that even better. Energy, cyclicals, communication services, tech, and basic materials were up, and the rest of the market kind of slightly lagging behind. Where do we stand on the 1 week relative? Well, we're still fairly mixed, guys. Half of the market to the upside, led by communication services, which largely is Google and Meta, although that will drop tomorrow because Google right now is down about 8% in the after hours after their earnings, so that will probably be reversed. But other than that, a fairly balanced market, all things considered. So before we get into more technical analysis, guys, let us dive right into the China tariff article, shall we? So in terms of the China tariffs, they were put into place very late last evening. So China counters with tariffs on US products. It will also investigate Google. Now, Google doesn't have a very large footprint in China, but this, of course, is sending a message that nobody is safe, essentially, in terms of scrutiny by China. So take a look at this. The top US imports from China with those 15% overall broad tariffs. The top US imports from China into the United States are as follows: cell phones, computers, and accessories. A lot of electronics, guys. Electric and industrial equipment, that's a big one too. Toys, games, and sporting goods. Appliances and furniture, clothing and textile, car parts, telecommunication equipment, cookware, cutlery, and tools, and shoes. As you can see, guys, we import a lot of stuff from China, so these bilateral tariffs could stand to hurt the US consumer more so maybe than the ones that would have been levied across Canada and or Mexico. China is a very much larger trade partner for the United States, so this is going to be key to watch because in 2018, they got into a little bit of a trade war, the US and China, and it took over 3 months to come to common ground resolution before those tariffs were eased. And the markets, I'll remind you, in 2018 did not like it at all. Now, in the midst of 2018, we were also going through a rate hiking cycle by Jerome Powell. That obviously added fuel to the fire, but the 2018 trade war was stuff of legends. However, this time around, China is in a much better position to absorb the blow of those tariffs. Moving on forward, China is much better prepared, announcing a slew of measures that go beyond tariffs and cut across different sectors of the US economy. Why is China better prepared this time? Well, because they learned the first time around. They are now no longer as dependent on the United States as they were 6 years ago in 2018. They have broadened themselves out to South America, Africa, and the lower portion of Asia as well, and really have a diversified set of trade partners now and are nowhere even close to being as reliant on the United States as they once were. So this one, Trump's tariffs against China, are not going to hurt as much as they did before. Let's move on further. It's aiming for finding measures that maximize the impact and also minimize the risk that the Chinese economy may face. face. These countermeasures by China, guys, are very, very calculated. Let's look into it, see what they're doing. China said it would implement a 15% tariff on coal and liquefied natural gas products, as well as a 10% tariff on crude oil, agricultural machinery, and large engine cars imported from the US. The tariffs would take effect next Monday. Now, China gets a lot of its coal and liquefied natural gas and oil from Russia. However, the US does export a decent amount to them. Let's move on further. The impact of China's measures on U.S. exports may be limited, though the U.S. is the biggest exporter of LNG, liquid natural gas. It does not export much to China. In 2023, they only exported about 2.3 of total natural gas exports towards China. So a very small market overall. So China is imposing that on liquid natural gas. It's not going to have an impact. However, what is going to have an impact is a few paragraphs below. Now, China imported less than 110,000 vehicles from the US last year, though the auto market analyst thinks that the tariffs will be painful for GM. So a few brands here and there can get affected by the Chinese auto tariffs, but China has never known to be a very large importer of vehicles from the United States, and nor so from Europe. They usually tariff those to the absolute moon. Just ask people who try to buy Mercedeses in China, and they sell for about 2, 3, 4 times the regular price that they do in any other market. China announced export controls on several elements critical to the production of modern high-tech products. This is where China is going to hit the US where it hurts. They include tungsten, tellurium, bismuth, molybdenum, and indium. If you guys don't know what they are, don't worry, guys. I barely know what they are either. However, they are critical components in the technology sector, many of which are designated as critical minerals by the US, meaning they are essential to US economic or national security that have supply chains vulnerable to disruption. So that is going to be the major focus, guys. The Chinese economy is not going to hit the US tariff for tariff. They are going to choose very selectively the products that can cause the most amount of pain with the least amount of pain to China. All right. So keep that in mind. And now lastly, they are going after Google, saying they're investigating Google on suspicion of violating antitrust laws. However, Google has a smaller presence in China than many markets. Its search engine is blocked like many other Western platforms. Google exited the Chinese market in 2010 after refusing to comply with censorship requests from the Chinese government after following a series of cyber attacks on the company. So Google has a relatively small footprint, but this is not so much to go after Google itself because they have a small footprint. It is to send a message, guys, that no American company operating in China right now will be safe from the scrutiny of the Chinese government if the US continues putting pressure in the form of tariffs. So that is everything for the tariff story between the United States and China. We will definitely have to closely follow this one, arguably a lot more than the ones from Mexico and Canada, because this can have the largest impact on the US economy, all other things considered. Now, that is everything for the tariffs. Now let's move into some earnings, shall we? And we're going to try to cover these as quickly as possible, but we're going to start it off with a banger, guys. We're going to start off with Google. So Google, prior to their earnings, were hitting new all-time highs today, almost $208. But then they had the earnings, guys, and we have this massive red candle from top to bottom. That was a decline of 10%, ending the day roughly about 8% earlier than when they started. So all in all, we are coming back down into this big support level. You saw the price right there. Sorry, it's not on the chart. 191 into the box of support, which puts us right about there. To prices seen. Yes, guys, prices not seen since last Tuesday. So essentially it was a big drop, but let's have a look as to why did Google drop 7 to 8%. And it was a question of the numbers being good, because it was a very good quarter for Google, but just not good enough. Similar to exactly what happened with Microsoft just last week. And we're noticing a common theme here, guys. Unless these companies truly eviscerate their earnings, to quote Alex Karp from Palantir yesterday, unless these companies truly eviscerate earnings, I think you're seeing a common parallel here. They have not benefited from the same rallies that we've been noticing in big tech over the last 2 years. You expect these big tech names to go up 4, 5, 6, 7, 10% after earnings, and they really have not been seeing that, at least for the last 2-3 quarters, as they're measuring up really against very difficult comparables, especially in their cloud revenue segments. Let's have a look at Google's numbers. They beat on EPS by 1.18%, and they missed on revenue, guys, by a fraction of a percentage point, 0.23%, but any miss is going to be magnified by Wall Street, of course. Let's move into the article, shall we? Alphabet shares drop as much as 9% on revenue miss, and soaring AI investments. Yes, they increased their CapEx by an amount that Wall Street was definitely not expecting. Let's have a look at that. So YouTube advertising revenue, 10.47 billion versus 10.23. Very strong numbers from the YouTube division. As a matter of fact, the YouTube search business and advertising business did well if you take their numbers and measure them in a bubble. The problem is that they're measuring against very tough comparable numbers from last year. And then we're going to see how it impacted the direction of earnings in the after hours. Google Cloud revenue was also a miss here, 11.96 versus 12.19 expected. The expectation was quite lofty and Google did miss. That was a 2% miss on cloud revenue. Traffic acquisition costs, the cost that it cost Google to get the traffic, of course, says it in the name, 14.89 versus 15.01. So at least that number was lower than expected, but does go in line with the above numbers too. Now, Google's overall revenue grew nearly 12% year over year. That is a fantastic number, guys. A $2 trillion company still growing revenue at 12% per year overall. Fantastic number, all things considered. The company's revenue growth, as well as growth for its search business, YouTube ads business, and its services unit were all slower than compared to a year ago. And this is where the problem comes in. Well, it's not so much a problem, but the reason for the drop. Advertising revenue was 10.6% growth compared with 11% a year ago. Miss number one, or rather lower than a year ago, number one. Number two, search revenue was 12.5 compared to 12.7 in the fourth quarter of last year. Miss number two, YouTube ads revenue growth was 13.8% compared with 15.5% a year ago. Miss number three, and growth for the company's services business was 10.2% compared to 12.4% a year ago. Miss number four. So you can see, guys, that if you take these numbers in an abstract bubble, right? If we just take these numbers and do not compare them to last year, they are very solid numbers, double-digit growth across all of Google's major lines of businesses. Overall, I think it was a very good quarter. They're just measuring up against very different comparables from Q4 of 2023, which were arguably record numbers for Google overall. The company also announced that it plans to invest $75 billion in CapEx in 2025 as it continues to expand on its AI strategy. That is above the $58 billion projected that Wall Street had anticipated. So this CapEx news, similar to Microsoft, similar to Meta, was not well received by Wall Street. Wall Street wants more profits, but the company is saying, listen, if you guys want more profits down the line, we have to invest in our business now. And that is exactly what Google is doing, similar to Meta and Microsoft, increasing capital expenditures versus Wall Street's expectations that they had built in since the month of December. Now, here's what the CFO had to say about this. Now, he said that the figure, talking about CapEx, primarily reflects the company's investment in its technical infrastructure, with the largest component being investments in servers, followed by data centers to support the growth of our business across Google Services, Google Cloud, and Google DeepMind. So as we can see, guys, no, they're not spending $75 billion to build a fancy chatbot. It is really to host their data. Google gets a ton of data, guys, from the ads business, the services business, the search business, the YouTube business, right? So many different lines of businesses, and you need state-of-the-art technology to process, store, and make sense of all the data. That is why they're using the money, guys, not to build a $75 billion chatbot. Trust me. The company's fourth quarter net income increased 28% to $26.54 billion. That is 27.5% net margins, arguably some of the best in the company's history so far. So a lot of money to the bottom line for Google. I love to see it. The cloud unit's revenue increased 30% from the prior year, but it was not good enough for Wall Street. Last year was 35% for Google overall. Last quarter comp over comp was 35%. Now they're down to 30%. Objectively speaking, guys, 30 is still an extremely strong number. Same thing as Microsoft, though. You remember Microsoft was supposed to come in at 31.8%. They came in at 31, and the market sent them down 6%. So this should be no surprise. Moving on further, asked if revenue for the company's cloud unit could have been higher with more compute capacity, similar to Microsoft. Could you guys have made more money if you didn't have the supply constraints, right? Here's what he had to say. We are in a tight supply-demand situation, working very hard to bring more capacity online. They will be bringing on more than throughout the year. They exited the year with more demand than they had available capacity. There is the kicker, guys. So as we can see, it is not a question of Google not having enough demand for its products. It is a question of them not having enough supply to give out to the market, which is exactly why they're spending $75 billion on all those brand new servers and data centers. Objectively speaking, guys, I'm very happy as a Google shareholder with this quarter. You can complain that the growth year over year was lacking in all lines of business, but they're going up against very tough comparables. In an objective fashion, guys, growing each and every line of business by double digits is extremely healthy. Net profit margins of 27% as well, extremely healthy. Take a look at Google's balance sheet, you will see that there's no problem with this company at all. They bring in an absolute metric ton of free cash flow per year, and this year was no different. They ended the year over 70 billion, and you can see here debt is not a problem for them, a lot of cash on the balance sheet, and a tremendous amount of free cash flow they bring in per year. In terms of EPS and revenue growth, you'll see these very smooth graphs up and to the right, smooth EPS expansion the next 4 years, and very smooth revenue expansion for the company the next 4 years as well. I do not see any red flags whatsoever. 30% year-over-year cloud growth, 27.5% net margins, we have already mentioned, and 2024 free cash flow record, $72.73 billion and $24 billion in Q4. The company makes money hand over fist, guys. They're growing revenue at an attractive 10.1% per year and EPS 15% per year, and that is for the next 4 years. Now, taking a look at the valuation at 193, where they sit roughly in the after hours, they have a forward P of only 21.4. This is dirt cheap, guys. This is cheaper than the S&P 500. And the forward PEG ratio, dividing this number by the 15, is a 1.43. Anything under 1 is good. Anything above 2 is high. So at 1.43, it is cheaper than most tech companies out there. Still one of the cheapest, or arguably the cheapest, big tech company in the entire market. For a long-term portfolio, this still is a buy for me. And even for a swing trade, guys, it is providing a juicy entry between the 190 and 180 on a long-term time frame such as the weekly, a little bit of a retest and possibly run throughout 2025. I would not be surprised at these valuations. Google does remain a buy, at least for myself. So that's everything for Google earnings. Now let's get into the problem child of the bunch, which is going to be Advanced Money Destroyer, AMD. So AMD coming out with their earnings after the bell today, and initially they had a very nice reaction. The stock popping, well, it was already up 4.5% today. Initially, the reaction was quite good, up another 5%. And then everything came undone. 15% top to bottom drop after earnings, which gives them, top to bottom intraday of about 9%, right? So not the best quarterly performance by AMD. At least the reaction from Wall Street was not the best. But objectively speaking, when we take their numbers, were their numbers good or bad? They were actually quite good. Let's have a look into it. But as we've seen so far, Microsoft and Google, the numbers were good, but if you do not eviscerate the numbers, to quote once again Alex Karp from yesterday from Palantir, you are not getting the same Wall Street love that you once were. So taking a look at EPS here, 0.83% beat on EPS and a 1.66% beat on revenue. That was just simply not enough for Wall Street, even despite increasing their margins. So let's move into it. AMD reports profit beat, but misses on data center revenue. And this is important, guys, because this is going to be their number one growth factor for the next 2-3 years. So it's kind of like cloud for Google and Amazon and Microsoft, right? For Microsoft, Google, and Amazon, it's all about cloud revenue. If you miss on cloud revenue, your stock goes down. For the chip makers, it's all about data center revenue. If you miss on data center, you're going to go down, even if the miss is quite tiny. So let's move into it, shall we? AMD said it expects 7.1 billion in sales in the first quarter. Analysts expected AMD to guide for revenue of 7 billion. So they beat the consensus estimate for Q1 at least. Let's move on further. Lisa Su told investors on an earnings call that AMD believes it will report strong double-digit percentage revenue and EPS growth in 2025. And this is true, guys. When we look at the numbers objectively, for the next few years, AMD will be growing revenue every year by a factor of 17% for the next 4 years, and EPS will be growing at an average rate of 38% per year. That is insane. Moving on further here, AMD reported 3.86 billion in data center sales, which was up 69% on a year-over-year basis. That is for the quarter. However, analysts were polling 4.14. There is your data center miss. That is a 6.8% miss. So even though this number is up tremendously year over year, because it does not come in line with analysts' expectations, the stock is down. That is fairly logical, though. For the full year, AMD's data center division revenue increased 94% to 12.6 billion. Guys, this is some of the best revenue numbers that AMD has ever had in the history of its business, but it's still not good enough for Wall Street. 12.6 billion for the full year for data center, and 94% increase. While AMD is far behind the market leader NVIDIA, this is true, it released competitive data center GPUs in recent years, such as the MI300X, that some big infrastructure buyers, including Meta and Amazon, have embraced. We believe this places AMD on a steep long-term growth trajectory led by the rapid scaling of our data center AI franchise from more than $5 billion in revenue in 2024 to tens of billions of dollars of annual revenue over the coming years, said Lisa Su. Even this guidance, guys, to tens of billions of dollars of revenue in the future was simply not enough for Wall Street. They want the numbers now, not the futurists. They want them now. So everybody, retail and institutions, are getting a little bit impatient with AMD stock. That is for sure. Now, when we take a look at the numbers, guys, you will see that the numbers, I'll be quite honest with you, the numbers are actually very good, okay? So here's your revenue for Q4. You can see nice increase here, 24% year over year. Gross margins for the Q4 year over year are also better, whether you measure on GAAP or non-GAAP. Gross margins are going up. Operating income, same thing for the quarter. Operating income is going higher, and earnings per share is trending higher as well. All metrics trending higher year over year for the quarter. Now, where do we stand in terms of the fiscal year overall? Well, fiscal year revenue, 25.8, increase of 14% year over year. That is a record amount of revenue. Gross margins for the year, also up and to the right. Operating income for the year, also up and significantly to the right. This is what you want to see, guys. More revenue, but also more profits to the bottom line. And now earnings per share, a nice increase in earnings per share. So here is the summary P&L for fiscal year 2024. We're going to use non-GAAP because it removes any one-line items, so we can just focus on the nature of the business. And I want you guys to notice gross margin increase 53% from 50%. Operating expenses are up less than total revenue was up, so the company does have operating leverage right now. Operating margins were up 24% from 21%, and the net income was also higher by a factor of 26%, far outpacing revenue. So they're getting more and more profitable as they scale into the market. However, this quarter was fairly weak once again for a few segments of the business. However, they are small segments, but they do still weigh down the sentiment of the overall stock. Data center revenue for the quarter, as you can see, was up in a very healthy fashion. Data center revenue was up, quarter over quarter, year over year, 69%, but quarter over quarter, 9%. We'll use year over year. But however, client was also their second biggest segment, up 58% too. Gaming is a big problem, guys. You got to think about Xboxes and PlayStations here. Inventory management issues from Microsoft and Sony. They're liquidating the last versions of their PlayStations and their Xboxes, and now AMD expects to get some new orders for those, but it has not been a very easy year for the gaming segment for AMD, down 59%, and embedded all the commercial applications for enterprise computers. Whenever a company orders 3,000 different Dell laptops for employees and stuff like that, that is embedded revenue when they come with AMD chips. That was also down 13%, as there just is not a very large PC refresh cycle right now. So overall, the smallest segments of the business were down year over year, but the biggest segments of the business were outperforming. So all in all, mixed results, but you do want to see the largest components of the business working up higher in a faster fashion. So overall, guys, I cannot say that I am disappointed with AMD's earnings. Did they come in under Wall Street's expectations? Yes, but on paper, are they very good numbers and showing a company that is expanding in a very nice way? Yes. Are their data center chips potentially less efficient and a bit slower than NVIDIA's Blackwells? Yes. Will they still be used because there's just so much demand that NVIDIA cannot keep up with the entire sector's demand? Also, yes. So it's a question of AMD's chips will indeed be used, and they are making some decent progress on them. I know they are not as fast at training large language models or AI models as the NVIDIA chips, but they are fairly good in terms of bang for your buck. They are also cheaper than the NVIDIA chips, all things considered too. So that is probably pretty much a rough rundown of where we stand in terms of AMD. I'll remind you of the thesis, guys. AMD is coming into their growth curve a bit like NVIDIA had at the start of 2023, starting to really ramp up EPS and really ramp up revenue in a significant fashion. These are some of the best years the company is ever going to have. But people just do not believe in the story. The company now in the after hours trading around the 108 level is back to prices that we had not seen since the later stages of 2023, as if none of this growth and none of this expansion had happened at all. I think investors and sentiment is really down in the dumpster right now, which makes me even more attracted to possibly build some positions in AMD at these lower ranges. So everything, all else considered, guys, non-GAAP, look at these net margins. AMD has never been a company with fantastic net margins, always around 6 to 10%. But in the last 4 quarters, they've really been ramping it up, culminating right now, 23.2% net margins for Q4 and 21% 2024 on a non-GAAP basis. They do not either have very much debt to contend with overall. As you can see right here, only $3 billion worth of debt, decent free cash flow per year, and a lot of cash on the balance sheet. So debt is not a problem for them. The data center ramp, said by Lisa Su, should be the same in the first half of 2025, but the second half of 2025 should be far better. So revenue and EPS growth profiles, extremely aggressive. Look at the valuation, guys. On a 2025 forward basis at $108, they sit at a 21.64 forward price to earnings ratio. This is cheaper than the S&P 500 for a lot more growth. Look at the PEG ratio, guys. Divide the PE by their EPS growth rate, average growth rate for the next 3-4 years. It is sitting at a 0.57. This is extremely cheap, guys. This is dirt cheap for this company. So I will be possibly looking to build a position. The company, guys, is trading at very cheap fundamental valuations. Yes, they are second place to NVIDIA, but they are still growing at very attractive clips. And also, guys, this is now the peak of investor sentiment drawdown. Everybody on Twitter, everybody on Reddit, everybody on StockTwits, wherever you look, even people on YouTube are starting to throw in the towel. Where have we seen this before in the past? Well, I'll show you where we've seen it in the past. We've seen it in Apple when people were throwing in the towel here, when there was all the DOJ in European Union investigation lawsuits, lower year-over-year sales and growth for iPhones, and Apple found a way to deliver consistent growth. People threw in the towel on Google with the Department of Justice headlines back here saying the company was finished. They were going to break up the company, cloud revenue was not going to expand, and that Google search was a dying business. So there are several opportunities like this in the market that come to us every now and then, where sentiment is at all-time lows. People start throwing in the towel at the very same point where the valuation hits extremely cheap metrics. So this one, I'm not here to convince anybody. I'm just here to say that there could be some very attractive risk to reward on this stock. Number one, for a swing trade from the lower levels, yes, if you have enough patience, because 2025 second half should be a lot more attractive for AMD, but also in terms of a long-term portfolio, well, this one's not for me. I don't put many semiconductor chip companies in my long-term portfolio, but if we're looking to make a possible 1 to 2 year swing trade on the expansion of the business and capturing market share in the data center landscape, I do not think it's a terrible proposition in the form of measuring risk to reward. Notice how I always put emphasis on risk to reward. I never said that there's not any risk. I'm just currently saying that the reward does outweigh the risk when you have a valuation like this. Your EPS growth rate could literally get cut in half, and the PEG ratio would only 2x to about a 1.14. That is what I call some very good margin of safety. So that is all your earnings that we had today on AMD. Hopefully you guys enjoyed that. And now company number 3, a little bit of a shift in terms of the segment that we operate in. No more tech companies. Now we're going to do a burrito company. Well, a fast food chain company, and see how they measure up against their competition. So Chipotle coming in after the bell with their earnings and top to bottom decline, unfortunately, about 6%. But is the company underperforming? Is their growth story finished? No, it's just that they're measuring very tough comparables, kind of similar to Google. 2023 was a fantastic year of expansion for Chipotle, and the numbers were record-breaking numbers back in 2023. So wrapping up the year 2024, they were measuring up against difficult comparables. If you take their numbers, objectively speaking, they were very strong numbers. But when we compare them to 2023, there is a slowdown in traffic and in terms of sales growth as well. But objectively speaking, guys, the numbers were very strong for Chipotle. They had a beat on earnings by about 2.09%, and they had an ever so tiny miss of $3 million on 2.85 billion total revenue. So very small miss in terms of revenue. Now, let's take a look at their article, shall we? So Chipotle earnings beat estimates, but stock falls on weak same-store sales forecast. And we will see how weak it actually is. Quick little hint, it's not really weak at all. So taking a look at Chipotle, the traffic to its restaurants keeps rising. However, the burrito chain disappointed investors with its same-store sales forecast for 2025 and commentary about weaker January traffic. Now, moving on further, the company's sales climbed 13.1% year over year. Fantastic. Same-store sales rose 5.4%, narrowly missing the street estimates of 5.7% growth. Guys, when you are a quick service restaurant brand and you are growing same-store sales between 5 and 7%, in a year-over-year fashion, that is like top tier of the range for any quick service restaurant. So please keep that in mind. They missed the numbers, but this company is still a market outperformer. There is not very many companies at all growing same-store sales in the restaurant business of 5.4% per year. Transactions rose 4% in the quarter, continuing the burrito chain streak of higher traffic. For the past year, Chipotle has outpaced the broader restaurant industry, which has seen traffic slump as many consumers opt to cook their meals to save money. Sales have been volatile so far in 2025, said the CFO. The weather, including the wildfires in LA, have been having a larger impact on foot traffic than it did last year. While we believe underlying transaction trends are healthy and we have a strong plan for the year, we do compare against progressively tougher comps in the first half of the year and therefore are guiding to a low to mid single-digit comp for the full year. Low to mid single digits means between 4 to 6%. You could put the midpoint at about 5. Wall Street was anticipating same-store sales growth of 5.4%, so missing the estimate once again on guidance, but still guys, 5% is very good for the quick service restaurant business. Executives said that tariffs would raise the company's cost of sales by about 0.6% percentage points. Really not that much, guys. That would be a translation to the consumer of maybe barely a 2% increase on a burrito bowl. So if you're looking at a, $15 burrito bowl, it might cost you $15.30. Not the end of the world, in my humble opinion. The company opened 120 restaurants during the quarter. This is the big thing you have to look out for Chipotle, is the amount of restaurants that they're opening. The company is still in full expansion mode right now and still opening stores aggressively. Chipotle is also trying to expand internationally. For example, it entered Kuwait last year, its first new country in a decade. For 2025, Chipotle expects to open between 315 and 345 new locations, more than 80% of which will have a Chipotlane for digital orders. Chipotlane is really the highlight of their business. It is not quite a drive-through. It is pretty much a pickup window where you can put your order in on the app beforehand, drive through the Chipotlane, and just pick up your order. It's already ready. Extremely efficient service by Chipotle overall. Now, moving into some of the numbers, we're not going to spend too much more time on this. I just want to highlight, guys, total revenue increase year over year, 14.6%. Comparable restaurant sales increased 7.4%. That is fantastic. They're squeezing out more and more money out of these restaurants without having to increase prices that much. So they're getting more and more popular. Operating margins, 16.9% versus 15.8%. The implementation of several automation processes, such as the avocado slicers and many other things in between, have increased their operating efficiency even more. This is fantastic. Restaurant level operating margins was 26.7%, an increase from 26.2%. Everything is getting better with this company here, guys. There is nothing bad to see, and they still do have $1 billion of remaining share purchase authorizations for buybacks, and they included an additional $300 million in buyback orders. So all in all, guys, I have nothing bad to say about this earnings report. Do they have tougher year-over-year comparable sales? Yes, but is the business currently in very good standing? Absolutely, guys. Take a look at the balance sheet for the business. You will see that it's not a problem for them. They've been improving net margins this entire time, and this quarter was once again a decent quarter of net margins, about 13-14%, which is very good for a quick service restaurant, all things considered. Taking a look at their balance sheet, yes, it's true that they have a little bit more debt that you'd kind of like to see, $4 billion, but I wouldn't say it's a problem, guys. It's a byproduct of expanding the business quite rapidly. $4 billion in debt, decent amount of free cash flow per year, and they do have a little bit of cash on the balance. Oops, my head is in the way. A little bit of cash on the balance sheet. That is of 2023. We'll get the updated numbers in 2024, but the allocation is going to be roughly the same for 2024 as well. Moving into the valuations, or rather the expansion of the company, you will see that EPS steady, smooth, and to the right, and the revenue steady, smooth, and into the right as well. Gives them a revenue growth rate of 11.5% per year. Very strong for Chipotle. EPS expansion per year through 2027 of 16%. Where do we stand right now? At $55 in the after hours. In terms of valuation, well, we stand right now at a forward P ratio of 41.3. Objectively speaking, this number is indeed high. And even when we divide it by their EPS growth rate, we get a PEG ratio of 2.58. Now, this is a little bit rich for Chipotle, guys, and this is the only problem with the company. It is a fantastic company. The problem with it is that it's ran so darn much. in the last 3-4 years that the valuation right now is getting a little bit rich, even if I have a little bit of, I'm willing to give them some leeway. It is a little bit rich, guys, at 2.58 PEG. Even the free cash flow yield, if you use the more defensive ratios here, free cash flow yield of 1.6, that is a little bit low. You want to see these between 2.5% and 5%. 2.5% is lower end of the range, which I'm willing to accept. 1.6 is just a little bit too low for me at these prices. Price to sales of 6.26, not that bad, guys. McDonald's, arguably the most well-known brand of that entire segment, is sitting at an 8 price to sales. So, when we're looking at the metrics, I'm not saying McDonald's is cheap at an 8 either, guys. That is actually somewhat expensive for quick service restaurants. Price to sales, a little bit rich. Free cash flow, a little bit low. And the PEG ratio, a little bit too high for me. So the company is fantastic, guys. If we are holding long-term shares, I do not see any reason to sell, but is it a good proposition to be buying heavy in this location? Probably not the best deal in the market. Will they do fine in the future as they continue to expand the business? Most likely, yes, but it's not the best value proposition. I can see a swing trade down here, 54, maybe to about the $50 location in this lower range. If we want to kind of pick the lows for the support area and try for a little bit of, monthly bottoming out here of the levels and go for a swing trade for the highs, sure. But are we looking for an absolute moonshot 2x of Chipotle in the blink of an eye? Most likely not, guys. I think that portion of their growth is somewhat behind us. Now they will most likely just consolidate at their current valuations and just maybe grind a little bit higher. Fantastic business overall. It's just sometimes, guys, a business is not its stock price, right? A company and a company's stock price are two different things. This is an example of a company that I love a lot, guys. Nothing bad to say about the company, but the stock price, just a little bit too expensive for me. And that is everything we had in terms of our earnings today. So hopefully you guys enjoyed those breakdowns of those various companies. Now let's get into some TA, shall we? So moving into the, whoa, that's a lot of text right there. Moving on to the technical analysis of the indexes, shall we? So we can see in the after hours with those Google earnings, the AMD earnings, we are down ever so slightly on futures. However, guys, we have not recaptured the daily uptrend just yet. I'll remind you of the context. The context, sweeping move to the upside, looking for the daily uptrend, did not get it. Daily downtrend at the current time. So right now we are still anticipating maybe the result of a lower high. If the bulls can put in more of a move to the upside tomorrow, they will create a 100% engulfing move, can go for the V-shaped breakout or at least the two-step recovery process of the uptrend. That is best case scenario. If we however head to the downside, guys, the expectation is for lower high into lower low because we are already in the context of a daily downtrend. If you get the break-in flush lower, we're just looking for a weekly higher low as well. Anything above 575, looking for a weekly higher low to get the weekly uptrend back because we know that we lost the weekly uptrend. Sorry, let me just zoom in here. We lost the weekly uptrend here. Now we have to get it back in a two-step process. Still some good defense, some very good defense areas below us. If we do come down there, 585 to 500 and the 26 EMA. You guys can see the S&P has done a great job of upholding this 26 EMA the entire time that they've been rallying for roughly the last 2 years. So overall, guys, not too bad of a day for the S&P, but just pay special attention to the levels to the downside if we break them, because on the upside, the bulls have a lot of work to do to get this daily uptrend back. Moving on to the Qs. The Qs also actually having not too bad of a bounce. We will see how they react tomorrow with Google's earnings to the downside. However, all things considered, guys, we are looking still for the bull break to the upside. It has just been a wild zone of consolidation, a very wide range, guys. Huge moves down, huge moves up, down, up, down, up. It's been very volatile for the Qs as of recently, and I do not expect that to stop until we get much out of this earnings season, which, lucky for us, ends pretty much with a banger. Amazon on the Thursday session, excuse me. So QQQ is not looking too bad. Still looking for a break to the upside. 531. Get me a break of the upside, guys. Daily uptrend is reset. We can then say that the weekly higher lows are set as well, and we are looking for the possible trend expansion of the Qs. However, come back to the lows, and we're looking at support to protect us once again, 515 to about 510. Break that to the downside. Unfortunately, daily downtrend continues. And then you have to look at the weekly levels here, guys. We'll still be looking for a weekly higher low for a possible weekly trend recapture because we did lose the weekly uptrends back here. Now we have to get them back. The last line of defense is down here, 500 down to about 495, a lot of space. And you can see, similar to the SPY, the Qs have done a very good job of protecting this 26 EMA ever since this rally started, guys. In March of 2023, they've been able to uphold that, which is why I say if push comes to shove and panic hits the markets, I think that maybe down here could be the last line of defense for the bulls before getting a lot bigger bid support. But as of right now, we have not lost any major levels. We're just kind of trapped in this consolidation since Jerome Powell. So no clearly defined trend right now. It's up to the bulls to prove it to us by breaking levels to the upside that they are showing up to play and that we are looking for another leg of monthly expansion. Keep in mind, this is kind of what seasonality says as well, right? January, mixed month. February also kind of a coin toss, and the early portion of March, similar, kind of a coin toss. It could be bumpy here, a lot more volatility catalysts on the horizon. We have non-farm payrolls. I'll remind you on the Friday session. I'm sorry, you can't see it there. It's all the way. Well, now they put everybody else's countries on my chart, so my apologies for that, guys. I don't think I can get the Friday. Let me just pull it up real quick. Don't want to spend too much time on this. I'll just scroll all the way down, and it should be down there. Sorry. So non-farm payrolls, you can see it's there on the Friday session. So overall, not too bad. In terms of fear and greed, we're still in fear, even while we're close to the all-time highs on SPY. Market momentum, as you can see, still a fear read. Stock price strength in terms of net new highs and lows on the New York Stock Exchange, still somewhat low levels in comparison with all of 2024. And stock price breadth, although we have come back, we are still in an atmosphere of fear, guys. So as you can see, the tensions, both in a geopolitical fashion from the tariffs, and also because these earnings have been somewhat mixed in terms of tech and the AI narrative, you know, it's leading investors to question whether or not 2025 can still be a beautiful record year, such as we had in 23 and 24 when we saw the SPY and the QQQ put in over 20% gains in back-to-back years. A lot of people are questioning, can we actually see some crazy returns this year as well? Or maybe this year might just be a consolidation year. Still too early to tell in my opinion, but those are just some of the concerns on people's minds. Moving into the XLF right now, down about 0.23%. Not the worst day for the financials, guys. Pay attention to this higher low, though, 50.43. If you break 50.3 to the downside, daily downtrend. But that is fine, guys. After such a massive engulfing move, even if you set up the daily downtrend, it is not going to do much of anything, guys. Weekly was a downtrend. Look, now we have the weekly engulfing move. What are the bulls looking for? Looking for the weekly higher low for possible further trend reset to the bulls. And the extent of the drawdown may be 49.6, touch of the 12 EMA. And below support 49 down to about 48.50. I think that this is the area where the bulls will find some beautiful support. You can see in the last 2 years worth of rally for the bulls, guys, usually when we come down between the 12 and 26. So if we do have a little bit of a retracement, that is where I think we would come down into 49 down to about 48.5. And that is where I will most likely be looking at some credit card companies and the banks to buy, but that obviously is just speculation. The bulls for right now looking very strong, and I would not even be surprised if we just continue in breaking new all-time highs and go for continuation of the daily uptrend. I'm just here to say if we do fall back, I will be a buyer down there, 49, 48.50. Moving on to healthcare right now. Healthcare still battling with the local highs, 147.5 to be exact. Still have not broken it to the upside and still have not broken it to the downside. Tight range of consolidation right now above the longer term moving averages too. That being said, it's going to be a question of watching which way this one breaks. If it breaks to the downside, no problem. Daily downtrend, what are the bulls looking to do? We're just looking to reset a weekly higher low to get a weekly uptrend back. It has been a sweeping weekly downtrend for the last 4 or 5 months. Now we have a nice engulfing move, but the work is not done. You need to reset the weekly uptrend. So if we do pull back on the daily, that is what they're looking to do on the higher time frame, looking for the weekly higher low and trying to go for the weekly trend change. If we just get a clean break to the upside, no problem at all. That will just be continuation of the weekly move, and it gives the bulls an even better chance of doing the good old breakout of this level. You can see the good old breakout, retest, and maybe run, then setting the weekly uptrend a little bit higher. All things considered, guys, the bulls have created a ton of space off the lows, and I would not be surprised if the healthcare sector starts coming back and starts providing some support that the SPY needs right now. We know the Qs are a mixed bag. Some days they're up 1%, some days they're down 2%. XLF has ran a ton and needs a little bit of a breather, but XLF is still well off its highs, so maybe it can provide some of that support that the tech bulls kind of need right now. In terms of semiconductors, we'll take a look at semiconductors right now. We are still doing absolutely nothing, guys. We are still trapped between two ranges. Overhead resistance, which is 250 up to 260, and below support, which is 230 down to about 220. Still trapped between these two levels, which we have been, guys, largely for the past 5 months at this point. I know. Everybody's getting impatient with semiconductors. I think they'll do good, but a lot of the guidance from a lot of these semiconductor companies are saying that the first half of 2025 is going to be similar to the second half of 2024. So similar in terms of growth rates, but to the end of 2025, that is said to be when that period should accelerate. Now, the market is always forward looking, so I'm not saying this chart will be range bound until the second half of the year. I'm just saying that the market is forward looking, so eventually we will start pricing in that end of 2025 growth, but maybe this one stays muted, possibly through the first half of February, maybe even into March, who knows? But NVIDIA has earnings at the end of the month. Maybe that's going to be the growth catalyst that really starts propelling the sector to the upside. But as of now, we are kind of directionless, right? Looking for the lows. If we flush these lows, 233, daily downtrend into support, and we'll see how the bulls react. Conversely, if you break 250 to the upside, new daily uptrend, but you encounter resistance. So I will only be reacting in a big way to this if we break a big level to the upside or a big break to the downside. Until that time, it's just a whole bunch of nothing, guys. So when it's doing a whole bunch of nothing, what is my favorite strategy? It is selling puts under the market on my favorite names, which I will continue to play: NVIDIA, TSM, and possibly Broadcom as well. Moving into the Russell, 1.38% to the upside. The Russell responding well today. The Qs were up nicely. Some of the industrials were up decently today. So the Qs found a little bit of a chance to rally, considering the fact that yields as well were down on the Tuesday session. So the Russell responding well, but I'm still not convinced that small caps are going to be the outperformers this year. Maybe I stand to be corrected, but small caps have been underperforming the market now for the past few years in a row. That being said, on the daily, we do have a nice daily downtrend here by the bears and resistance at about 231 to 225 coming into it now. Do we just get shut down with a lower high into lower low? We will see. But what the bulls need to do is we need to engulf, break through the top end of resistance 232 and come and sit on it, use it as support, and then go for the breakout. That is what the bulls want to see. I'm still on the fence whether or not we're actually going to see it, but that is what they're looking to attempt. That is on the daily, and this is how the weekly is shaping up as well. If we can get the clean break, it will be a clean weekly uptrend smashing through support, and the bulls will have a lot more momentum than they have right now. To the flip side, if we come back down to this region, 217 to 210, could be an area that I'd be willing to revisit this trade. But as of right now, IWM not willing to call it until they give me a clean break of resistance. And now lastly, the Dow Jones up about 0.3%. Not the best day for the Dow, not the worst day for the Dow either. They're kind of just chilling like the financial sector. Higher lows are set right here at about 43,900, let's call it. So any move, looking for the higher low, we got it. And now we are looking for the possible trend expansion. However, if we do not get the follow through and instead we roll over and flush the lows, is it that big of a deal, guys? No, the bulls are working with tons of space on the weekly time frame. Take a look here, same thing as financials. Weekly downtrend, big engulfing move. Now, if we do get the daily downtrend, we're just looking for some weekly consolidation, looking for a higher low, anything above 41.8, looking for that higher low for further trend continuation, similar to the XLF. The Dow usually has come down between the 12 and 26 EMAs during periods of consolidation in the last 2 years worth of rally. So if we do pull back, that is where I do think the bulls step in and play some defense. Talking about 43,000 roughly is the horizontal support range and between the 12 and 26 EMAs. So looking quite decent for the Dow, all things considered. Now, in terms of yields, we'll skip over them. They haven't moved too much. And even crypto, guys, we'll skip over that. It just hasn't moved. Still the exact same analysis as yesterday. Trapped, guys. You want to see the breakout on Bitcoin, needs to break 107 to get the daily and the weekly uptrends back in motion. If not, we are just going to play the same range bound game that we've been playing for the last 2 months, the bottom area of which is 91 to 87. This is where I'm looking to possibly position on Bitcoin. But right now, in between the highs and the lows, I'm just not interested in taking any big positions here other than writing puts under the market on BITX way below the current price. When we get some big red days, I'm writing all the way down there and collecting some juicy premium in the interim. But as of right now, crypto just not moving. Into Apple, as a matter of fact. So Apple up 2.10%, reversing some declines from early on in the week. But we know that they still have a lot of work to do, these bulls, right? So keeping in mind that it is a nice daily uptrend right now. The bears took back a lot of ground after the earnings, but the higher lows are now set at about 226. We will see if the bulls have it in them to completely recapture this entire move and at the same time break through this resistance line, 237 down to about 231, prior resistance, current resistance as well. We will see if they can get it done. If they fail and roll over and break yesterday's low of 226, that would be a new daily downtrend, and we would be heading right back into support 225 to about 215. I maintain my stance on Apple. If we retest the lower range of 215, I'll be looking to write some short puts 210 and below, just because the valuation on Apple right now, we did it after earnings, but the valuation right now is a little bit high on Apple, considering their very flat revenue growth year over year, which is why I'm not really in a rush to buy Apple at these heightened levels. It's a very solid company. Yes, indeed, it has not lost the weekly uptrend either, but until we get a clean break, maybe a breakout, retest, and run, I don't want to play the upside, guys. I would rather be patient, wait for some lower levels, and write puts where I actually want to buy the company, which is in the $200 range. Moving into AMD right now, well, we covered their earnings, but now let's cover their price action. So right now, after the bell, they're currently standing at about 108. Currently in the depths of the support level. Support levels not seen since the later stages of 2023. They have now erased all of the 24 gains and now coming into 2023 levels as well. The bottom end of which is about $98, $97, and they're now below the 200 weekly EMA. Normally, AMD has not traded much below the 200-day EMA since 2016. Only once back here in the depths of the bear market, that was 2022. So right now, at these very crushed valuation levels, and also opening up tomorrow, they may be close to daily oversold. On the weekly timeframes as well, we will be quite low. So I'm a fan of making some swing trade attempts on AMD, but we have to go light. I will be using short puts under the market as of tomorrow morning. If I can find some short put premium down here in the mid 90 range, I will be going for those as well. But even for some possible swing trades to the upside, guys, if we're looking at call options or call debit spreads, just understand the sentiment around the stock right now is quite sour. It can take a decent amount of time to turn around a freight train of monthly downtrending patterns, a freight train of weekly downtrending patterns as well, and unfortunately, a smaller freight train of continuous daily downtrends. Eventually, it will find a bottom, but timing the bottom, guys, is anybody's guess. If we are looking to build positions moving forward, I would say that if we're looking at any leap call options, for those of you who are interested, I would not be interested in anything under a June 2026. I want to give myself as much time as possible for this stock to find a local bottom, for sentiment to bottom out, everybody capitulate, and then we start to ride to the upside. As I said, the risk reward is favorable, but I understand it is not everybody's favorite trade. I'm not here to convince you to take this trade. I'm just talking objectively whether or not it could be a good risk to reward trade. And I do indeed think so, because in my opinion, fair value for AMD, considering their growth in the next 2, 3, 4 years, fair value conservatively is about $140. I'm not even going up here, which is what some analysts are targeting. I think fair value sits around 140. It's not that big of an ask, but even from here, guys, from the lower 100s, that would still be a rally of about 35% to the upside. So that is the fact of the matter for AMD. Moving on to Amazon now. Well, Amazon, it's a bit tough because they're going to have their earnings coming up on the Thursday session. I'm not too sure how they're going to respond to the Google Cloud numbers coming in under the estimate, but this is the cloud leader in the market. That being said, very healthy daily uptrend being maintained by Amazon. The higher lows are currently sitting at 232.78, but I would be highly surprised, guys, if we start cracking 250 before earnings, or if we start really breaking down below 230 to 225, which is the support below us, much before earnings as well. The earnings expected move is going to be approximately, we only have 2 short days left for Amazon, but the expected move for this week with earnings is going to be about 5.5% to the upside. 5.5% to the upside puts you well above the 250 range. If we maintain here at the current price, that would put you about 254. To the downside, that would put you right back into our box of support. One thing is for sure, if I can see Amazon come back down here, gets hit like Google, gets hit like Microsoft, goes down 6-7%, I will be very interested in buying, or rather writing some options in the lower 220 range, 220 down to 215, my preferred area for Amazon. The bulls are looking very, very strong on this company overall. overall, guys. Weekly uptrend is nice, so any extended pullback will just be looking for a higher low for possible further trend continuation, which is why I like this support range right there. Confluence with the 12 EMA, and that is the same level I was talking about earlier, mid-20s down to about lower 20s, 225, 220 on the mark. Moving on to Google right now. So Google, obviously in the after hours, they will be back down to roughly about the 192, putting them right into the area of support that we've been talking about for the last 3 weeks of time. If for ever reason, well, we break this to the downside, it will become resistance. But as of right now, it is still acting as support. First thing tomorrow, I will probably be writing some short puts in the low 180 range for the following week for Google. I love this range down here, 180 to 174. I think down there the company would be incredibly cheap. It is currently cheap right now at 193. At the lower 180s, it becomes even cheaper. And I do think this company will have a fantastic time expanding their business for at least the next 2 to 3 years. Google is not done. They just had a little bit of a slump after their earnings, which is completely normal, guys. It happens to the best of these companies. So keep an eye how this breaks. But now at this point, we have probably lost the daily uptrend by flushing these lows. Now, whether or not the bears can convert this into a downtrend or whether or not we're able to just claw it back, that is to be seen in the future days. But I know for sure that down here, I will be writing some short puts and looking to pick up some shares on Google in the lower end of the range. I do still have one long-dated call option on this company for June of 2026, and I am fairly bullish on this position through the remainder of the year as well, despite this little early pullback. Moving on to Meta right now. Meta up 0.96%, but even Meta, guys, I mean, Meta had fantastic earnings as well. Did they go up 9, 10, 15%? No, same concept, right? Kind of stuck. You can argue they had their pre-earnings rally. Same thing for Google. You can now argue they had a very nice pre-earnings rally. So maybe a lot of the earnings bullishness was priced in. But for Meta, one thing is for sure, beautiful daily uptrend right now. Higher lows are arguably set already because they did temporarily lose the hourly uptrend. As we can see right here, we did lose it temporarily. Now, so that being said, you can argue that the higher lows are here, but in all reality, I truly think they're still down here, right? This is one big daily move looking for a higher low. Anything above 607 looking for that higher low. We will see if Meta consolidates. It is currently daily overbought conditions, so I'd be a bit nervous starting a swing trade position up here. I'm more keen on waiting for a little bit of a pullback, maybe into the moving averages. 670 down to about 650 seems to be a decent location. I'd be highly surprised if we do the full give back, but if we do the daily downtrend into weekly consolidation, understand what the bulls are looking for. Just looking for the continuation of this gorgeous weekly uptrend here, guys. Anything at this point above 589, looking for a weekly higher low for further trend continuation. If I can find it in or around the 12 EMA, which is this line right here, which will be curling up, 650, not a bad position to maybe make a little bit of a swing trade attempt for a bid for Meta continuation throughout the year. Moving on to Microsoft right now. Well, Microsoft still struggling at the lows after their earnings, doing a whole bunch of nothing. But that one thing is for sure, guys, we're just trapped. Similar to semiconductors, trapped between two levels. Overhead resistance, 430 down to about 425, and below support, 405 down to about 390. All things considered, Microsoft is still trading below their 200-day moving average. Not that bad of a deal. We covered their earnings, and Microsoft, guys, is doing fantastically. Same problems as Google. They just do not have enough output capacity to keep up with the demand. That is a very good problem to have. Now, that in mind, we are still trendless right now. The bulls need to reset a daily uptrend with a higher high and higher low pattern and then convert and then smash through this resistance. But overall, I'm a big fan of buying Microsoft down here, whether it's for a longer dated option play, whether it's for shares for a long-term portfolio. This area, 410 down to 390, guys, I think is extremely good value for Microsoft, all things considered. They very rarely dip below their 50 weekly moving average. In the context of an overall bull market, you can very rarely find, this is the bear market, by the way, 2022, very rarely does Microsoft break and hold below their 50 EMA. So I do still think on a technical basis, it's a good trade and fundamentals are expanding in a very beautiful fashion as well. I remain bullish on Microsoft for 2025. Moving on to Netflix right now. So Netflix making an attempt to break through $1,000. They did it early in the morning and they snapped right back. But the bulls are trying to go for it here. They're trying to go for the daily uptrend expansion. We'll see if they can get it done. Break down below here, though, without a clear break and close above. If you break down below 950, you are unfortunately going into some form of a daily downtrend and just looking to maybe retest the former area of support. 940 down to about 901 is going to be the mark. That would be very healthy weekly retest, weekly breakout, retest, and possibly run for Netflix through 2025. That is the style of swing trade that I would be looking for, not so much bidding the highs here and going for the absolute breakout. Although it can work, I'm a bigger fan of just waiting for a retest of the levels and maybe filling the gap that the earnings left. It's still very close, so I'll be patient in waiting for it. And if it just runs away and I cannot take it for a swing trade, no problem, guys. I have some long-term shares. Still very bullish on the company. Their earnings were fantastic. We covered them a few short weeks ago. If you were not able to see those earnings, I definitely recommend taking a look at that video, which is about 2-3 weeks ago on the channel at this point. Moving into NVIDIA right now. So NVIDIA, 1.71% to the upside, and I do believe that they got a little bit of love in the after hours, although you cannot see it right now. They did, upon earnings announcements from Google of the extended capital expenditures, they did bounce, right? So we have Meta, we have Microsoft, and now we have Google. We'll hear about Amazon too, but we have 3 of the big hyperscalers saying that they're increasing CapEx a lot more than they thought this year. What do you guys think that's going to have as an impact to to NVIDIA? Well, obviously, that's going to have a very nice impact on their revenue and in their pipeline for future revenue as well. That being said, NVIDIA right now trading at a relatively fair price, about the 118, 120 level, right above support at 120 down to about 115. Not terrible, but the golden spot for NVIDIA, in my opinion, if we come down because of tariff news, because of DeepSeek news, because of whatever news, all the noise, as I call it, if we come down here, guys, fantastic buying opportunity, in my opinion. Still below the 200-day EMA right now, which is this green line right there. And top to bottom, right now for NVIDIA, 25%. In their most recent history, it has been a good proposition to start buying NVIDIA when they're down 25% from local highs. I can go all the way back here to March and April, 25% almost, and even last fall, or fall of 2023 rather, they came down about 25%. So 25% is a decent first bid, but the absolute very good bid is down here 35% off the highs. I would very much like buying that, so I am constantly writing puts under the market at the lower $100 range, farming some premium, and if they choose to come down here and assign me, everybody's going to be panicking. At that point, when they come down here, everybody's going to think, oh, they're just done. Same thing as here. They think, oh, we're going to zero now. Not the case, guys. NVIDIA's valuation is quite solid, although we have lost the uptrends right now. Look, we are now from 142, right? We are now how much lower than 142 when we did the valuation? We are now 20% lower. So you reduce this PEG ratio by 20%. Which is pretty good, right? 1.94 times 0.8, reduce it by 20. The PEG's sitting at a 1.55. That is very decent, a very decent price for the price of NVIDIA's growth. And if they drop another 10%, the PEG's going to be sitting at a 1.3, 1.35. That is fantastic pricing for NVIDIA, guys. So a decent little discount on this stock overall, but we have lost the technicals. It is a weekly downtrend, yes. It is still a daily downtrend as well, maybe expecting lower lows. Eventually, they will find a local bottom. I'm just here to say I am nibbling in this location, but I will be going a lot more heavy if we drop down there, all things considered. Moving on to Tesla now. So Tesla able to save the lows. Once again, guys, Tesla does not want to give back these low prices. And that line exactly is going to be 375. So we know the context right now is a daily downtrend for the bears. The bulls need to get their butts in gear, need to really start breaking back above 418. Give me the engulfing move, use the support to reset the higher lows, and give me a brand new daily uptrend. Only then will you know weekly consolidation is done. This little weekly consolidation phase can be converted, into a new uptrend and go for the break of 430. However, over the course of this week, if we lose the lower 375 level, that will officially be a weekly downtrend, and we will be revisiting the 350 to 330 area, which is my preferred area for possibly buying Tesla. As of right now, the way I'm trading this one, no, I'm not building long positions here. I'm just writing puts under the market in the lower range, as close as possible to 340 to 330 as I can get. All things considered, Tesla bulls are holding up the price nicely, but be very careful if they break this range. We are going to drop a level, and that could be roughly 10% lower than where we currently stand. Moving on to Palantir. Palantir up 24% after their earnings, and kind of just chilling here with the God candle, right? This little candle here in no man's land. So obviously blue sky breakout, guys. The technicals are extremely difficult to predict. All I can say is it's a massive daily uptrend, and any move lower is going to be looking for a higher low. Anything above 74, looking for a daily higher low for possible further trend continuation. Now pay special attention to the hourly time frame. If you want to know when this move higher is going to be done, watch the hourly. If we break the lows of today, tomorrow, hourly downtrend is in motion, and you might be seeing a little bit of daily consolidation to start off the remainder of the week after these earnings. All things considered, though, incredibly difficult to determine whether or not they continue this rally or whether or not they pull back first and continue. If they do pull back, guys, I may be tempted to write some puts in the $75 to $80 range, but we have to pay special attention, guys. The valuation right now is quite rich at an 8 peg right now in terms of EPS growth and in terms of a price to sales of over 60. Those are extreme levels, but got to give it to the bulls. They are doing a very good job of upholding the weekly uptrends right now. So any pullbacks, unless proven otherwise, are still, I know it sounds crazy, they are still for a higher low to go for further and further upside until we get proved otherwise. So fantastic earnings and fantastic day of price action from Palantir. We will see which direction this one chooses to go, but definitely not a bad location to be maybe taking some profits on those swing trades, writing some covered calls against your shares, and overall just being a little bit more cautious instead of being extremely greedy right here, right? Don't get trapped. Moving on to SOFI now, lastly, down about 0.71 is SOFI on the day. Not that bad of a day overall, but then again, just not an expansionary day for the company, right? Daily downtrend is now still in motion. If we continue breaking the lows here, guys, it'll just be continuation of that daily downtrend. Lower end of support stops at about 14. Below that, guys, unfortunately, there is not much before the $12 and $11 levels. So the bulls really looking to protect this range. That being said, they've established a nice shelf of support, which goes all the way back to about 2021. It's these guys from back there, and we are using them again. We still have the opportunity to set a weekly higher low and go for a potential new weekly leg higher. But overall, guys, you've seen, other than Palantir, right? These companies can report very solid earnings numbers and still somewhat come down if they've had a tremendous rally into their earnings session. So I still like SOFI. I will still be looking to write some puts under the market, roughly 14, 13, and 12 as we move lower. And I do have some exposure to the long side in the event the bulls choose to recapture. If you want to see the bulls back in control, very simply, guys, you need from now to get a break of 1654. That would be an engulfing move, allows the bulls to then reset the daily uptrend, to put an end to weekly consolidation and go for the weekly expansion move. But as of right now, it is just sideways consolidation for this stock, but I would not say that there are any major red flags apparent on the chart. So that is everything I had for today's video, guys. Hopefully you enjoyed today's video. If you did, consider dropping a like, would really appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these every Monday through Friday after the close. And of course, tomorrow we'll be going over more company earnings that we have in the names of Uber, possibly Walt Disney. I have to choose between Walt Disney or Qualcomm and ARM, but we'll be doing a few of them. Uber, Walt Disney, Qualcomm, and ARM are all up for analysis. And then the big ones, of course, on the Thursday after the close, Amazon, Elf, and we may even take a look at some Cloudflare or Fortinet, whichever one jumps out to me the most. So we're kind of wrapping down a certain portion of tech earnings overall. Still a lot of trade to be had, but in other news today, guys, if you want me to do a very quick rundown, right, very quick rundown. PayPal down 13%. Top line revenue growth problem, guys. Am I buying PayPal? Not really, guys. Is it going to be a recovery story? Yes, but a very long one. They're not growing top line revenue. Cost control is good, but top line revenue is bad right there. Other earnings from the day, I forget them all, but if you want to take a look at other ones, Spotify continues to be an absolute champion. The valuation, however, now very, very, very lofty, extremely tough to start a position, but they continue improving margins, continue improving subscriber counts, and the business just keeps growing. It's just buying it up here, guys, is extremely expensive, so just take that one to the bank. And in other news, Enphase also performing quite well today, as a matter of fact. Enphase coming up after the close here, posting numbers that were less bad than anticipated. That could be the moral of the story. So they are up nicely in the after hours as of the close. If I put it on the extended hours here, you'll see they are popping, but still roughly trapped, guys. It's going to be a very tough environment for solar moving forward, but trying to find some form of a base of support at 63. I'm still not playing this one, guys. I would rather, to be honest with you, play FSLR. I think the valuation is better, and I think the growth prospects for the company are better as well. Pepsi Corporation also coming down a little bit after their earnings too, bottoming out at the really low levels of 142, which is prior support from 2020, the highs of the pandemic, essentially coming down, trying to find a base of support. They continuously have to battle with the Quaker Oats recalls that they've had over the course of the past 3 quarters, and just consumer discretionary spending, which is lower, leading to increased promotional spend by the company and a reduction in prices to kind of attract people to start buying more things again. We know the consumer discretionary trade is a very difficult one, and it has been difficult for both Pepsi and companies like McDonald's and Coca-Cola, which all really have not moved much and have not set new all-time highs in at least the past 6 to 9 months worth of trade. Those are just a few very brief recaps, just to let you know that I am looking at the entire rest of the market on a daily basis overall, guys, right? It's just that we talk about the ones that retail is most interested in on a daily basis, but hopefully I help you guys when I bring these companies up on different earning cycles, or when I show them to you in my trades, because I trade a lot of companies outside of this list in my trades that I show you to you on the Monday or Friday, and give my thought process and analysis on those stocks as well. And even on the top 5 options play videos for the Sunday sessions, I always give you guys 5 top 5 options plays and like 10-15 bonus plays on a regular basis. So I do cover a wide amount more stocks, just not so much in these video recaps to begin with. And that's pretty much everything, guys. If you do want to join our private Discord, well, I'll just show you the private Discord real quick. If you want to join the private Discord and have access to all of these trades, we do the put wheel strategy. We do call options, call debit spreads, put credit spreads, leap call options, long-term portfolio plays. These are all the trades since the inception of the Discord. So you guys can see usually very consistent trades, but I cannot guarantee that past performance is going to guarantee future results, of course, but you guys know me by now. I have a somewhat conservative strategy, but it is a very consistent strategy to say the least. Right? So if you want access to all these trades and these trading styles, the link to the Discord is down below. We also do private morning live streams from Monday through Friday before the open for about, or rather during the open, for about 2 hours, where I trade live and take all your guys' questions on your stocks and your options. If you cannot attend the live streams, they are always recorded, guys, so you guys can see them later. And you can ask me your questions in our chat rooms all throughout the day, and I usually answer extremely quickly all throughout the day as well. And also you get private videos I do not show on YouTube, you know, anywhere from psychology videos to how to grow account videos as well, market psychology videos, how to manage wins, how to manage losses, how to grow a small account into a big account, how to trade a large account, also advanced option strategies that I do not share on YouTube, a lot of which are already on YouTube from other creators, but not the ways that I do them, guys. You guys know I have a very systematic approach to the way that I trade options, so those advanced strategies from me are also in those videos, and so much more. And additionally, you also get access to all of my trading view lists, whether it be this list, the options list, the large account wheel list that I do not share these companies on YouTube, a curated list of companies that I only trade with my very large high 6-figure portfolio, other than the YouTube portfolio that I show you guys. Other than that, my high conviction stocks as well, for large trades and larger swing trades too. All those lists come to you as part of the Discord as well, and also all of the charts and all the technical analysis and the indicators. Whenever I do earnings recaps on companies like this, they all come baked into the chart, as well as all of my support and resistance levels and my chart layout overall. Over 100+ different stocks that I've analyzed and have analysis on them and annotations. Those all come with just a quick click of a copy button for my chart layouts. If any of that interests you, well, the link to the Discord is down below. And if not, I guess I'll see you back on the channel, guys. Thank you so much for watching. Pleasure as always. Have a good day of trading tomorrow, and I will see you tomorrow after the close. That's it for me, guys. Take care and peace.